Pakistan's Finance Bill 2026 is now moving to the National Assembly with fresh recommendations after a parliamentary committee wrapped up its clause-by-clause review. But the final meeting raised some major questions. Why are mobile phones still so heavily taxed? How serious is the government about electric vehicles, and why should tax relief for airlines be limited to PIA? The National Assembly Standing Committee on Finance, chaired by Naveed Qamar, reviewed the government's policy on imported and locally manufactured mobile phones. Officials told the committee that mobile phones are taxed through tiered structure based on price. The tax burden starts at around Rs 1,500 per unit and can go as high as Rs 141,500 for expensive handsets. Phone worth up to $30 face a 25% tax. Those between $31 and $100 are taxed at 36%. Higher-end smartphones face rates of around 40 to 41%. According to officials, mobile phones imports generate around Rs 37 billion in annual revenue, with Apple devices alone contributing to Rs 21 billion. But lawmakers question whether these taxes are helping the formal market or pushing consumers towards non-PTA phones. Committee members proposed an installment-based tax payment system for mobile phone registration, saying similar models are used internationally for consumer goods. Naveed Qamar directed the FBR to work with the Pakistan Telecommunication Authority on a feasible installment plan. FBR Chairman Rashid Mahmood Langrial suggested that taxes on phones priced up to $200 could be reduced, but he warned that any reduction would create a revenue shortfall that would have to be recovered from somewhere else. The committee also reviewed Pakistan's proposed 5-year automobile policy, as the current policy is set to expire on June 30th. Officials said the new framework aims to lower import tariffs and reduce business costs. Duties and taxes are proposed to be reduced across several engine categories, including smaller cars, motorcycles, and auto parts. The debate then moved to electric vehicles. FBR officials said electric cars priced up to Rs 75,000 or around Rs 20 million would remain exempt from federal excise duty. More expensive electric vehicles would be taxed. Lawmakers questioned the logic of promoting electric vehicles without adequate charging infrastructure or clear policy direction. MNA Shahida Akhtar Ali asked how electric vehicles would operate in a country already facing power constraints. Sharmila Farooqi said the government must decide whether it wants to encourage EVs or treat them as luxury items. The committee also took up aviation sector tax relief. Initially, the government had proposed exempting PIA from 18% sales tax on a new aircraft leases and spare parts, but members argued that the relief should apply to all airlines, not just the national carrier. They said limiting the exemption to PIA would distort competition and hurt any new airline entering the market. Despite initial resistance from the finance secretary, the committee decided to extend the exemption across the aviation sector from July 1, 2027. Officials said the government would explain to the IMF that the measure is necessary to maintain fair competition. Lawmakers also said that if airlines are receiving major tax relief, passengers should see the impact in ticket prices. The committee's recommendations will now go before the National Assembly. For the government, the central challenge remains revenue. But for consumers, the question remains simple. Will these tax changes make phones, cars, and air travel more affordable, or will relief stay limited to policy papers?